Section will be building on what you've learned in TPM1. One thing to keep in mind is that our analysis of candles is actually the analysis of what others are thinking, where their beliefs are, and expectations for what's occurring in the market. This understanding of candles will take it to another level for you, well beyond the thoughts of whether it's a chaining of the guard, or some of the more esoteric names like bearish engulfing patterns, dark cloud covers, morning stars, and so on. It's always about what others think, what they expect, and what the pattern then communicates to us about the future direction of prices. Candlestick analysis is the foundation of our trading method. The reason for this is that we are primarily focused on price and looking at price patterns. Okay? Those price patterns speak to us about how other traders have acted. And this is the key in viewing patterns on a deeper level and understanding what's happening in the market or a particular stock that you're trading. By looking at candle patterns from the point of view of them telling you what the current beliefs and expectations are of other traders in the time frame being viewed, you'll begin to have deeper insights into market action, and that action will become less mysterious to you, because what you want to do is put yourself into that pattern that's being traded to understand what others are feeling and what are their expectations and beliefs. Are their beliefs about that pattern coming to fruition? Meaning, if they're long, based on a buy setup, is it moving in the direction you anticipated? Or is that pattern beginning to fail? Right? We're going to delve deeper into this when we get into bar-by-bar analysis. Each candle is going to speak to us about the supply and demand relationship within that bar, in that time frame, and in relation to prior candles. And we'll delve deeper into this in the support and resistance section. An arrangement of candles forms of recognizable patterns. And when you think about the pristine method and the type of traders that we are, you could say we're, in a sense, pattern traders. That's what we're looking for. They are recognizable patterns that have occurred in the past with the expectation that those patterns have predictable value of what's going to happen in the future. Those patterns are going to speak to us about the potential direction of prices, again, why we call it candle language. And then we're going to have to combine the other concepts in this seminar to increase the accuracy of them significantly. Remember, each course, part of the course in this seminar, is a little mini course in of itself that you're going to combine these various concepts together for making your trading decisions. As the bottom of this slide says, do not take this slide for granted. It's going to be the building block all else will be built on as we go through the material. Considering the fact that you've all taken TPM1, I know that you know the basics of candlesticks. I know you know where the high, low, open, and close is of a candle. And the candle on the left is a bullish candle, since the close is above the open. And the candle on the right is a bearish one, since the close is below the open. But I want you to start thinking about these points on the candle from a different point of view. Meaning, the opening price is going to be the beginning of the supply and demand relationship within that particular bar. The high is going to be where there was enough supply or resistance to stop that bar from growing or increasing in size. That's going to become our reference point of resistance, our initial reference point. The low is going to be where there was enough demand or support to stop that candle from moving lower. Now, looking at the red candle and looking at the low of the bar and thinking at it from that point of view, as we look at an individual candle, our thinking would be, well, if enough buyers had stepped up to the plate at that time to create that particular low in the bar, there must have been enough demand at that time. If that wasn't the case, the candle would have grown larger and would have moved lower. Same for the high. And at the high point, there must have been enough sellers or supply to stop that candle from growing larger or moving higher from that point. The ending point is going to be where the supply and demand relationship ended, where there was an equilibrium at that point. And the body is going to be the degree by which the battle is won or lost. As we look at the size of the candle body, where it is in relation to the high, and where it is in relation to the close. On the left side of this slide are common candle terms, which is engulfing bars, piercing bars, dark cloud covers, aramis, thrusting lines, doji stars, hammers, and hangman. And there's quite a few more. There's probably at least 50 or 60 different candle names of different types of patterns. In the end, really the terms are going to be unimportant, and you'll see why. It's not necessary for us to remember these names. But on the right here is pristine terms. Right? In all pristine concepts, we look to simplify. So a changing of the guard means that these have different levels of penetration into a prior bar's range. And this is all the names on the left are really doing. So whether you're looking at an engulfing bar, a piercing bar, a dark cloud cover, and so on, in essence, what you're really determining or defining is how far prices penetrate or close into a prior bar. So when we look at a changing of the guard, this is what we're interested in, to look at how far prices have penetrated into that prior candle. With the doji, stars, hammers, and hangman, we call them narrow range bars, narrow bodies, bottoming tails, and topping tails. What's common to all of these is that the candle body is narrow. Right? So when you look at these, the thought that you want to have is that different levels of slowing momentum has occurred. Lastly, a wide range bar means that there's been an increase in the range relative to the most recent bars. Right? We're not saying that it has to be $1 or $2, 50 cents, or what have you. We're just looking at the range relative to the most recent bars and determining that it is a wide range bar. As I said, the terms are unimportant. It's the candle's message that's key. Don't assume the outcome of the current candle. This is a trap. As that candle is forming, you have no idea what it's going to look like. And as we delve into this material further, you'll see exactly what I mean and how important those messages are while that candle is forming, and then what it will be at completion. Candle is not complete until that time period ends. Well, if you're looking at a 5-minute chart, you need to be aware of how much time is left within that candle's period. And if there's 3 minutes left and it looks like a bullish wide range bar, that's going to produce certain beliefs about what's happening. But what if at the end of that 5-minute bar it looks like a topping tail? It's a completely different message. We're going to combine the messages so that they're going to speak to you, and you'll see how this all comes about as we put this information together. The changing of the guard bar. A bullish changing of the guard is defined by 3 or more consecutive red bars followed by a green. Bearish changing of the guard, 3 or more consecutive green bars followed by a red. And as we can see, there are different variations of this, but the message is always the same. There has been a reversal in momentum. As we look at the various examples here, what we see is that there are different levels of penetration into the prior candle. So with the examples on the left, starting from the far left, we see that the penetration was less than halfway. Then with the next, more than halfway. The third one, completely or more than 100% above the high of the red candle, or the most potent of the reversals. The ones on the right, just the opposite, right? A less than halfway penetration, more than halfway, and more than 100% of the bearish changing of the guards. The one on the right is the most bearish. Here we have various setups, starting with a buy setup. We have 3 or more bars moving down in an uptrend. Now with the various setups, you'll see they're all named, starting with the bullish doji star. Now along the lines of proper thinking, I want you to think, what makes these bullish? Now these are the accepted names for these patterns, but think about it as we go through them. Are they really bullish? Does it reinforce our thinking as professional traders to even think of them in this way? So when we look at the first example of a bullish doji star, we see that it gapped down and the opening and closing price were the same. Now, this particular pattern is one that just tells us that there was a stall in the downside momentum. It actually gapped lower. So what makes this bullish just because the momentum slowed down? It's the name in of itself. doesn't make it bullish. At the next one, bullish star, gap down closing over the open, leaving a small real body. Again, while the downside momentum has slowed, it has closed above its opening price. It is somewhat more bullish than what the prior movement in the bars have been. Right? The downside momentum has slowed down, but in of itself, is it a reason to take a trade? No. The next one, bullish inverted hammer. Think about what this looked like prior to completion. And this particular bar had rallied up into the prior bar and then fell back down toward the lows, while it closed above its opening price, giving it a somewhat degree of bullishness compared to the prior bar. Right? We still don't have an entry point for this particular setup. Right? The bullish hammer, narrow range body with a bottoming tail near the lower end of a prior bar. So as we're going through these particular setups, you see they're starting to become more convincing as potential setups to consider buying, because we do have a buy setup, meaning 3 or more down bars within an uptrend. So with this bullish hammer, what did the bar look like prior to the completion? It looked like one of the prior red bars, which means there was continued selling during that time period, and then buyers stepped up and pushed prices back up toward the high. The bullish Arami opened near the prior bars, closed, fell, and rose during the day, closing with a small real body. So with this particular example, it didn't take out the low of the red bar. Right? It opened near the prior close, closed above the opening price. It is a narrow range bar. Right, now we need to see, can it trade above the high of that bar, giving us a signal to enter. The bullish thrust, this gap down. So the current bearishness that was occurring during those 3 red bars continued with a gap down, or what we would call a novice gap down, and then buyers stepped up, creating demand, pushing prices back up toward the high of the current bar's range, but it couldn't push more than halfway into the prior red bar. The bullish piercing gapped down and closed halfway into the prior range. So now prices are moving further and further into that prior red bar, where the signals are becoming more potent. When I say the level of supply is decreasing, meaning it's absorbing the supply from that red bar. Lastly, we have the bullish engulfing bar. This gap down and rose up to engulf the entire prior real body. This also took out the high of that prior bar, which, as we covered on a prior slide, was a area of resistance. So this one is the most potent of the signals, and actually the most bullish of all. On this next slide, obviously we have the opposite of the prior. And again, what you want to begin to think along the lines of, just because we give a pattern a name, meaning a bearish star or a bearish hangman, bearish piercing pattern, and so on, is it really bearish? Right? So again, as we look at these individual candles, we're going to ignore the names and watch the pattern itself to see what type of pattern formed. What did the candle look like prior to completion? How far has it penetrated into that prior candle? In reality, what we're looking for, has the prior information been negated? Has the turning point by the formation of this bar actually signaling an entry point? This is what we are most interested in. Of course, this is how we're going to make money. So as that bar forms, is it a clear signal to take a position or not? How bearish is it when we look at these various turning points? And as we look at them, the last 2 examples are the most bearish, right? The piercing pattern and the bearish engulfing pattern, because they have penetrated deeply into those prior candles. But while you focus primarily on narrow range bars in Trading the Pristine Method Part 1, right, these larger bars, or these bars that move more deeply into a prior bar, which can be wider range bars or larger bars, which will require larger stops, can actually be the type of bars that have the greatest odds of success, because they're giving you the most potent signals. Narrowing range bars, the NRB. Here we have a series in which the difference between the highs and lows is narrowing. In other words, the momentum is slowing down over a longer period of time. So as we look at each individual candle that's formed, what we see happening is that momentum had increased and it's slowly beginning to diminish, indicating the potential for a turning point. There's nothing to do here but to observe what happens next. What is the next bar that forms as the narrowing range bars begin to form, and we're recognizing that momentum is beginning to slow down. We're waiting for that next message to form, meaning that next candle. What is it going to look like? And what is it at time of completion? We don't know, obviously, right, what it might be. It could be a chaining of the guard. It could be a bottoming tail. It could be a topping tail. We need to let that next bar form. But at this point in time, we can recognize that momentum is slowing and the probability of a turn is near. Narrow bodies. Bars in which the body of the candle is small relative to the overall length of the candle. They may have tails on either side of the body. This is an interesting type of candle. It's one that is an indication or communicates indecision. It's one that many traders get confused when they look at them because, again, it does communicate indecision. It doesn't tell them what to do next, and that is the message. That don't do anything yet because there is no clear message here, but the momentum is slowing down. There's going to be different variations. But again, the message is always going to be the same. There's been a slowing in momentum. As I mentioned previously, when we see narrow bodies, the thought that that's going to produce is that momentum is slowing down. So if we have a series of candles that have been moving lower, especially over an extended period of time, and we begin to see narrow bodies, that will produce a thought that momentum is beginning to slow, and the probability of a turn is likely near. Now we need to wait for the next candle message. For example, with the image on the left, we see that after the narrow bodies, a large green candle formed that closed near its high. The fact that it closed near its high tells us that buying continued right into the end of that time period and is likely to continue. So we do have a signal that prices are likely to begin to move higher at that time. Right? Now we need to see if prices will trade above that candle's high. As we covered in that static slide of the green candle and the red candle, we said that the high of that candle is going to be resistance. So the next question becomes, can it trade above that candle's high? With the image on the right, we just have a narrow body. So the message is that while momentum slowed down, we don't know what's going to happen next. The next candle could be a green candle closing above that candle's high, indicating that momentum is increasing again to the upside. So while this narrow body, or what's commonly called as a doji, doesn't necessarily mean that prices are going to begin to move down, we have to wait for the next candle. The only thought you want to take away from this particular candle is that momentum has slowed down and you're waiting for the next message to occur. The wide range bar. A bar in which the candle's body is relatively wide compared to the most recent bars. Now these can form in two different ways that we're most interested in. A wide range bar after a period of low volatility, it ignites momentum in that direction. In other words, if prices have been consolidating, in other words a base, and a wide range bar forms, like the example on the left side here, a wide range bar is igniting a move out of a consolidation. The message here is that you've had a powerful move out of a consolidation, and now you're looking for prices to continue to move lower. The next question is, how are you going to enter? Meaning, if prices are going to move lower, that means I want to short prices in anticipation of lower prices. Now, as we covered in that first example with those two candles, the red candle and the green candle, our reference point of support has to be that candle's low. So at a minimum, we need to see the low of that wide range bar being broken for a signal. Now ideally, what would happen is just what we see in this particular example, where prices would retrace from that wide range bar and we would get a pristine sell setup. Notice the topping tail at the high of the pristine sell setup, that it traded above those two prior bars highs and formed a topping tail. This is an excellent entry point after a bearish wide range bar igniting a move out of a consolidation. Now, a wide range bar after an extended advance or decline typically happens near the end of a move. Why is that? Because as prices are moving down, for example, over an extended period of time, initially you have buyers stepping up. They're not so sure that prices are really going to go down. And as prices continue to move down continuously, eventually more and more traders begin to believe in the prevailing trend. And as the majority begin to believe, the ranges begin to expand. As more and more sellers come in to that particular stock, overcoming what demand there might be, eventually it begins to swarm over that demand and taking over it, and there are fewer and fewer buyers. And when the majority move to one side of the sentiment of what's happening in that particular stock, this is where the turning point typically comes. At a minimum, there's usually a stall in the momentum. And think about, how do we recognize a stall in the momentum? We'll see a narrow candle body or a narrow range bar. Tells us that momentum is stalled. So in the image on the right, we see a wide range bar ending the move. And after multiple candles down, the range expands, and then we see a small candle body and the momentum stalls. Later on in the pattern, there was a retest of that high, and that consolidation of those multiple bars going sideways in that retest was the volatility contracting. And then there was a wide range bar igniting a move higher. So we have a wide range bar igniting a move higher from a period of contracting volatility. And notice that the wide range bar, right, the bar on the right here, igniting the move higher from that retest pattern, closes on its high. Now, when a bar closes on its high like that, that means that there was strong demand into the end of that time period. And what I want you to be thinking about is the fact that that bar closed in that area was because demand was strong into the end of that time period. But why did the bar close there? In essence, why did that bar end? Because we chose to use a particular time frame. And at the close of that bar, at the end of that time frame, demand should not stop. So that wide range bar igniting should result in a move above that candle's high and a continuation of that move. Topping tail bars and bottoming tail bars. The topping tail bar is a normal or wide range bar in which prices had been higher, and then supply forced prices to close below the midpoint of the bar's range. Again, supply forced prices to push prices lower, below the midpoint. It's about supply and demand. Sellers overcoming buyers within that time period. There are going to be different variations. The message is always the same. There's been distribution, and overhead supply has increased. Why has overhead supply increased? Because during the formation of that topping tail bar, it was a green bar. And near the top of that bar, momentum slowed down, sellers overcame buyers, and pushed prices lower. Meaning that those buyers at the top of the bar are now holding losses. And at that supply created by those traders holding losses will come into the market if it trades under that bar's low. This is what increases supply. Bottoming tail bars, normal or wide range bar in which prices had been lower, then demand forces prices to close above the midpoint of the bar's range. Demand means that buyers stepped up while prices had been falling and overcame that supply and then pushed prices higher. This is what forms a bottoming tail bar. Now again, there will be different variations. The message is the same. There's been accumulation. Right? Demand means that there was accumulation. and that overhead supply has been removed. Meaning, as prices were moving lower, sellers were coming into that stock. Right? So that means that supply was coming out of the stock, that's selling, and buyers were accumulating that stock. So when it forms a bottoming tail bar, the message being that buyers have overcome sellers, if this is now a message that prices can begin to move higher if it can trade above the high of that bottoming tail bar. Last point to take note of, the most potent tail bars will also have a wider range than the prior bars. Just like when we talked about the wider range bars, that increase in range is an indication that there's been a motion related to the move that has happened. So when we look at a bottoming tail bar, notice the bottoming tail bar with the star underneath it. It is a wider range relative to the prior candles. So this was a wide range bar, or a range expansion to the downside. Selling had increased. It had become climactic, if you will, right, with the increase in range, and then buyers had stepped up. So there was a complete change in sentiment there, or the movement of power from sellers to buyers. On the other hand, in the image to the left, the second example, you see two bullish wide range bars moving up, right, a powerful message that prices are moving higher, and then it formed a topping tail bar. But that topping tail bar's range is not wide relative to those two bullish wide range bars. So we want to give that particular topping tail bar less weight, if you will. Right? The message here is, if we were long, let's say that at the low there, that was a pristine buy setup, and now we were long and we see these two big bullish candles moving up, and then we see a topping tail bar. Well, while the message is that the momentum slowed down and the probability of prices moving somewhat lower is good, right? It's not enough of a message to us to really give up our shares at that time from an initial powerful message like that. This is where we want to see what the next bar that forms and what its message is, and potentially can that topping tail bar be ignored. This is where the most powerful information will come from as we start to look at these individual candles as they form. Let's review some of what we've talked about up till now. With the candles on the top of this slide, we have a narrow range bar, narrow relative to the wide range bar. The bottoming tail bar is what we'll call a range expansion bar. Right? We're going to take note of bottoming tail bars and topping tail bars, whether they are also range expansion bars. So a wide range bar is going to be a range expansion by definition, right? Because it's relatively wide compared to the most recent bars. A bottoming tail or a topping tail may or may not be a range expansion bar. That we're going to have to see, right? Wide range bars and range expansion bars display commitment and emotion. This is what we're focused on. What others believe, what are their expectations, looking at those patterns. How committed are they to what has just occurred? A range expansion can be an indication that momentum may soon slow down or is close to reversing. Right? So a wide range bar that has occurred after multiple bars moving in one direction is an indication that momentum may soon slow or may be close to a reversal. Narrow body bars may be a range expansion, meaning a bottoming tail or a topping tail bar. A wide range bar breakout or breakdown after consolidation ignites a move in that direction. This is exactly what we want to see if we're trading a breakout. If we buy a breakout above a consolidation, ideally, the bar that would form, once it's completed, would be a bullish wide range bar. That would be a clear message that prices should go higher. There was strong demand coming out of that consolidation, many buyers overcoming whatever sellers there were, or very few sellers, and a wide range bar formed. In the case of a breakdown, we want to see a bearish wide range bar igniting a move to the downside when we short breakdowns. A narrow range or narrow body is going to be a more reliable indication of a turn after a wide range bar. Because when a wide range bar forms after multiple bars moving in one direction, as a narrow range bar forms or a narrow body, it tells us that the momentum has slowed down. Remember, when a wide range bar forms, we don't know what the next bar is going to be. So, in reality, the next bar could be even wider than the prior bar that we had interpreted as being a wide range bar. So we need to wait for that next bar to form to see if the momentum actually slows down, and then the odds of a reversal will increase. A bearish wide range bar followed by a bullish wide range bar or vice versa are very powerful reversal signals. So if we were to get a bearish wide range bar, strong message that prices are going to go lower, and that message was completely negated by a bullish wide range bar, in other words, a complete reversal, it would be a very powerful message that prices were going to reverse or have reversed and are going to move back in the other direction. Potent reversals and pictures of fear and greed. On the upper left, we have a potent reversal. Notice how the candle closed well above the red candle's high. It actually gapped up from the red candle's close and moved above the red candle's high and closed above it. This is a potent reversal. It's a strong message that prices are going to go higher. With the example on the left to the right of that potent reversal, we have what we'd call not a potent reversal, meaning while it penetrated into the prior red candle, it didn't even move 40% into that red candle's range. So it's not a potent reversal. It's a message that momentum is slowed down, but it's not potent. And it says the larger the reversal bar is in relation to the prior bar, the more potent it is. Then the level or depth of penetration into that prior candle is going to increase its potency. Now, with the third example, second from the right, we have a potent reversal. Why is it potent? Because we had a green candle that closed near its high, and by definition a green candle means that it closed above its opening price, and then it gapped down all the way to that candle's open. Now again, I want you to put yourself in that candle, meaning you owned this particular stock and you bought it near the end of the trading period, right, up near that candle's high, and on the next candle it gapped down near the opening price and not too far from that prior candle's low. What are you thinking? Not a pleasant thought, is it? Right? And it then closed down near its low and below the low of the green candle. Right? Again, a potent message of a reversal and the likelihood that prices are going to go lower yet. The last example on the right would not be potent. While it's a big red candle, it had gapped up. Selling did occur during that period and prices declined. But that selling pressure or that supply that was coming in, overcoming the demand from the gap up, was unable to penetrate deeply into that prior candle's close. So we are going to define a potent reversal as one that could penetrate deeply into a prior candle, and ideally what we want to see is it penetrating, say, 70 to 80% into that prior candle. Now, expanding range indicates fear or greed is increasing and becoming extreme. Expanding ranges, increased volatility, increases the odds of reversal. So in our example on the lower left, we see that fear is increasing. As prices are moving down, bar after bar, as the ranges are beginning to expand, fear is increasing. The majority are in agreement that prices are actually moving lower. And the thought is that they will continue to move lower, and as the majority come into an agreement, then odds are there's going to be a reversal soon. Now, assuming that this was in a downtrend, and we see this type of a pattern forming, and we do get that slowing in momentum and prices begin to retrace, be aware that a pristine sell setup after a pattern like this is going to have lower odds. Right? Even if the pattern has not become climactic yet, defined by an extended move, right? The fact that the bars became wide-range bars, as these formed here, means that fear did become climactic. And a pristine cell setup may not be a high-odds setup at that time. Whereas the example to the right of that, where momentum is slowing but fear is not extreme, this is more of the ideal of what we want to see for our pristine cell setups, where prices began to move down strongly. Notice the wider range at the beginning of the move, and then the slowing momentum with the smaller candle body. And then we look for prices to begin to retrace from there. So fear hasn't become extreme yet. Fear has actually ignited the move down. So as prices retrace and we get that PSS, this is the kind of pattern that has greater odds of taking out that prior low. With our green bars, our third example, right, momentum is slowing, but greed is not extreme yet. So in this example, we had greed, if you will, igniting the move higher, which is bullish, and then momentum began to slow down. So as prices began to move higher and higher, momentum begins to slow, as traders feel that prices have moved too much or too fast, too soon, and they become less aggressive, and they're looking for prices now to pull back, or some profit taking begins to come into that particular stock. As we look for pristine buy setups, this is the type of pattern that we want to be looking for, where the ranges begin to narrow, momentum begins to slow down. Greed is not extreme yet, but as prices retrace from this pattern, there's an excellent likelihood that once we get the next changing of the guard, or pristine buy setup, prices will advance above that bar's high. With our last example, where greed is increasing and becoming extreme, right, more and more traders are getting in alignment with the move. They're becoming more aggressive on the buy side. Demand is overcoming whatever supply is there, and we get a wide range bar. These are the kind of patterns that we want to sell into when we are buying from a pristine buy setup. So as prices are running higher and we see a wide range bar, greed is increasing, we should be thinking it's getting close to time to sell. Pullbacks from such bars are going to be lower odds setups to be buying a pristine buy setup, because greed has already become extreme. Now, while that type of a buy setup can result in prices advancing, it's not going to be the highest odds setup. This is what you want to be aware of. Let's review. Our example on the upper left, we have a wide range bar starting a move down. And as prices are moving lower, we see the momentum begins to slow. This is not a climactic type of a low, right? And it's not a potent reversal. There's no fear associated here, just slowing momentum. So a retracement from a pattern like this would set up a high probability pristine sell setup. At times, patterns like this do not even retrace. Sometimes they'll only move up for one bar, and then selling will come in and we'll get a resumption of the selling if supply is extremely strong. Now, a retest of this low as a buy setup would have larger odds of a retracement. Lower left, here we have a range expansion after low volatility igniting a move down. And this is what we want to see if we are going to short a breakdown. Right? This would be the ideal type of bar to form. Upper right, range expansion followed by a complete reversal, making it very potent. So as prices move down, the ranges expand until we get a bearish wide range bar, a climactic type of a setup. Right? The range expansion, by definition, means that emotion is becoming climactic. The majority are in agreement at that time. And then there's an immediate potent reversal with prices closing up near the high of the green bar's range. It's a strong signal that prices are going to begin to move higher from a pattern like this. Now, while the pattern is one where prices are moving down very strongly, it's one in which it often sets up a high probability low. Again, a retest of a pattern like this will become a high probability entry point for longs, which we'll review in another section. On the lower right, we have a bearish wide range bar forming after multiple bars moving up. So while the move up, the bars moving up were not climactic, meaning there wasn't a bullish wide range bar, a climactic emotional bar, there was a very potent reversal. So the message here is strong that prices will begin to move lower. Again, retests of patterns like this, a retest of this high, will set up a high probability entry point for shorting, which we'll review in another section. What were traders thinking as these bars formed? What were they thinking at the completion of these bars? For example, our bottoming tail bar at A is also a range expansion, and it was a bearish wide range bar prior to completion. Put yourself in the bar. On the left side of the slide here, we have a breakdown. Right? A bearish wide range bar was forming. You shorted under the lows, and the bar looked like that big red bar while the bar was forming. Naturally, you're going to be thinking, great trade. It's going in the direction I had anticipated. We're looking for lower prices. When it completes and forms as it is at a bottoming tail bar, what are your thoughts now? What are you likely to do? If it starts to trade higher and takes out the high of that consolidation, what are you going to do? Obviously, you're going to buy to cover that position. In other words, you are going to bring demand into that particular stock and potentially drive it higher above those highs. Of course, you are not the only one in that bar or have formed that bar. This means that there are greater odds of prices moving higher. This is how you need to start looking at candles, thinking about what they look like while they were forming, what do they look like at completion. Put that message in the context of the prevailing trend and the overall pattern, and you will begin to see how new opportunities will begin to unfold in front of your eyes. Look at B. There was a bullish wide range bar breaking out above those prior highs. At the completion of that period, it was a topping tail bar. Now, what if you were to write into your trading plan that I will only trade climactic sell setups when I get a topping tail bar that breaks out above two or more prior bars highs, and climactic sell setup, and you have an extended move already. So the message here is that momentum traders got caught on the wrong side of the trade, and now they are most likely going to sell if it trades under those bars lows. This is how you can increase the odds significantly when trading against the trend. Lastly, in our example on the lower right, at C, what were they thinking after C? So prices were moving down. There was a continuation to the downside, a bearish wide range bar breaking lower, and then it was a complete reversal at C, a bullish wide range bar up, a complete reversal of the bearish bar. Again, a very strong message. Traders have gotten caught on the wrong side of the move. They're going to cover those positions, and prices should be driven higher. Now again, I point these patterns out to you. Right? There are different variations. You're going to see different variations on different days. So as we look at patterns, realize that different patterns are going to form on different days. Different patterns will form because of different time periods. So C in another time period could look like a, you got it, bottoming tail bar. Right? So as the data is changed in different time periods or on different days, you will see different patterns, but you're focused on the message as well as the pattern. Has a significant shift in momentum occurred? This is an important question to ask, especially when you're going to trade against the trend. In our example here, we have prices extended away from their 20-period moving average. Now, different patterns can form or different type of reversals can form. So as the size and number of candles that make up a reversal increase, the potency of the signal is going to increase. So on the far left of our examples here, we have the least potent, meaning we have a green bar followed by a red bar that the ranges are relatively narrow. In other words, momentum just slowed down. In our next example, we have prices having gapped up above the high of the green candle, and prices then penetrated and closed more than, let's say, 60 to 70, even 70% into that green candle. So a more powerful message than the prior one. The next one, prices had moved higher, right, traded above the high of the green bar, and then traded below the opening price, and down and closed on the low and below the low of the prior green candle. And so a topping tail bar that's closing below the low of a green bar. A more powerful message yet. Our next example, we have a bullish wide range bar, right, where the range began to expand, and it was followed by a gap up. Right, prices had opened up above the high of the green bar, and then fell all the way below the low of the green bar and closed on its low. Lastly, we have the most potent. We have a range expansion green bar here, right, closing up near its high. Prices had been higher. Remember, the topping tail bar was a green bar prior to completion. Prices closed below their opening price and closed on their low. And the next bar opened up in the area of that topping tail bar's close, and then traveled all the way down below the low of the green bar. Right, so here we have a 3-candle pattern incorporating a topping tail and range expansions and a strong move down, the most potent message that prices were going to move lower. And so as the size and number of candles that make up a reversal increase, the potency of that signal is going to increase. Let's take a look at some of these candles in action. In the upper left, we have a narrow body. Now, by definition, a narrow body tells us that momentum has slowed down, nothing more. This particular narrow body does give us a bit more information in that it was a bottoming tail bar, right, that did move down into that green candle's prior low area. Now, of course, the next candle is where we start getting more information. That bottoming tail bar could have been followed by another big green candle. And so don't assume that a narrow-bodied bar is going to result in a sharp move down, like we see here. Okay? So as prices began to move down, right, we see that narrowing range bars begin to form. In other words, momentum is beginning to slow as prices begin to drop. So in other words, buyers are beginning to overcome sellers. Now, take note of this bottoming tail range expansion. The blue arrow is pointing toward a bottoming tail bar. What did that candle look like prior to completion? What was its message? What were traders thinking? Did some of them get caught on the wrong side of that move down? Did the Johnny-come-lately start shorting it, thinking it was going to go lower? What are they thinking now? The message here is that prices are going to retrace higher. Now, this was a strong move down. Now, as prices begin to retrace higher from that point, we see that the ranges begin to narrow again, and then you get a changing of the guard, signaling that prices should begin to move lower. And note the bearish wide range bar that forms from that reversal, igniting the move down. Now, as prices begin to move lower, they come into the area of that bottoming tail range expansion bar. Note the bearish wide range bar that forms right into that low. And then you see narrow bodies begin to form right to the right of that bearish wide range bar. Right? Notice the tails on both sides of the candle body directly to the right of the bearish wide range bar. Right? This candle tells us that momentum is slowing, and it's happening in the area of that prior bottoming tail bar, which is normal. Buyers are going to step up in the area of a prior bottoming tail bar low. But as we started in this section, we said that the candle, the high of the candle is going to be a point of resistance. So as the momentum slowed down, and then eventually you did get a little green bar that formed in that series of candles, prices never traded above a prior candle's high, meaning that prior candle's high was resistance. Prices never traded above it. And then they began to move down again, and eventually you then get another bearish wide range bar as prices move lower, and then you get a narrow body and a potent reversal down at the low. Prices then retrace and you get another changing of the guard, and then you begin to see eventually a bottoming process begin to occur. Notice the various changing of the guards and the retracements. Right? There is a reversal pattern up there with a third candle making the combination potent. As prices retrace back down to the low again, we did get a reversal down at that low, but we're going to define that as not being potent because it did not retrace and close more than 70% into that prior candle. Okay. And it says focus on the message of the pattern, not the terms. Whatever you're going to call them, they're reversal signals. Pristine sell setup and tradable chaining of the guard. After the extreme weakness, or that downward strength, that set up a tradable chaining of the guard, not what we would call a PBS. A PBS by definition should occur in an uptrend with the expectation that it'll overcome the prior high. After such an extreme move down, right, we would not anticipate overcoming the prior high. But a tradable chaining of the guard does set up an opportunity to trade after an extreme move such as we've seen here. It also does set up the first PSS, that high probability setup, to short after such a move. Now on the move down at the low, there's another tradable chaining of the guard after an extended move to the downside, which sets up the next pristine sell setup. At the bottom, there's a 3-candle combination. You have a bearish down bar followed by a bottoming tail and a bullish bar closing up near its high. This pattern suggests a move back up to retest a prior area of resistance. Now, the last pristine sell setup, right, you will see later on why this one has higher risk. Although it did decline from that prior high, when we get into retracement analysis, you'll see why this one had greater potential to actually begin to move higher from there, or the pristine sell setup had a prior probability of failing. Candle language thoughts. A reversal candle's potency is measured by the depth or level of penetration into a prior candle. Tails on a candle are either going to increase or decrease supply. Top tails increase. Remember, top tails were bullish green bars prior to becoming top tail bars, and buyers have gotten caught inside that bar. Bottoming tails decrease supply. Bottoming tail bars were bearish red bars prior to completion, and demand overcame that supply and drove prices higher. Expanding range bodies tell us that selling power is either being ignited or exhausted. Right? A wide range bar. And a wide range bar after low volatility ignites a move. A wide range bar after an extended move exhausts a move. Narrow or narrowing range bodies tell us that volatility is low where momentum is decreasing. In other words, bottoming tails, topping tails, narrow bodies, narrowing range bars. Right? So as we look at candles, our thoughts are always about the reversals. How potent are they? Are topping tails or bottoming tails forming? Are those bottoming tails or topping tails also range expansion bars? Wide range bars, meaning momentum is increasing, but is that momentum increasing igniting a move or potentially ending a move? And as we look at candles with small candle bodies, they tell us that the momentum is beginning to slow down. And we will be putting all of this in the context of support and resistance and the trend, which will be in the upcoming sections that we'll be covering.